People think the US lost power because another country straight up replaced it, but that's not how this story really goes. Even today, the dollar still sits at around 57% of global foreign exchange reserves, which is insane dominance in a world that keeps calling America in decline. The real twist is that power didn't get stolen. It started leaking out while nobody fully took the throne. And that's where things get weird, because the global system isn't flipping from one king to another. Instead, reserves are slowly spreading out into multiple currencies like euro, yen, and smaller players trying to grab a slice. So instead of one big challenger, you've got a messy, fragmented setup where no one fully replaces the center. At the same time, America's balance sheet tells a different kind of story, one that's less about dominance and more about pressure building under the surface. The US net international investment position is deeply negative, meaning it owes far more to the world than it owns abroad. That gap isn't just a number, it's basically the cost of staying the world's financial hub. To understand how we even got here, you got to go back to Bretton Woods in 1944, when the global money system was basically rebooted after World War II. The US dollar was locked to gold, and other currencies were locked to the dollar, making America the anchor of everything. It wasn't just power, it was control of the entire financial plumbing system. But that system had a hidden bug built inside it from day one, because the world needed more dollars to grow trade and liquidity. The more dollars the US sent out through aid, military spending, and imports, the harder it became to keep every dollar backed by gold. So America had to choose between global liquidity and keeping the gold promise fully solid. By the early 1960s, that pressure was already showing cracks in the system. Foreign-held dollars started piling up beyond US gold reserves, which meant the promise of $35 per ounce was starting to look shaky. Basically, America was printing trust faster than it could print backup collateral. Then the 1970s hit like a financial earthquake, and confidence in the dollar system started slipping hard. Countries were trying to swap dollars for gold, and the US gold stash was getting drained way too fast. That's when Nixon stepped in with the famous 1971 move that shut the gold window completely. That moment wasn't just policy drama. It was a full reset of global money rules. The US basically said the dollar no longer needed gold backing, and the world had to adjust on the fly. It was like changing the engine of a plane mid-flight while still expecting it to cruise smoothly. A couple years later, they tried to patch things up with the Smithsonian Agreement, adjusting currency values and hoping confidence would come back. But markets weren't convinced, and the pressure kept building anyway. Soon after, currencies started floating freely, and the old Bretton Woods structure was officially done. What's crazy is that instead of losing power, after that system collapsed, America actually gained a new kind of flexibility. Without gold constraints, the US could run bigger deficits and expand financial influence way more aggressively, so the system didn't break American power. It reshaped it into something more elastic but also more risky. From the mid-1970s onward, the US trade balance started locking into a long-term deficit pattern. There were occasional fluctuations, but overall the country kept importing more than it exported year after year. That gap wasn't an accident anymore. It became part of how the system functioned. At the same time, the structure of the real economy started shifting underneath the financial dominance. Manufacturing jobs, which once sat at the core of American strength, began shrinking over decades. The economy didn't collapse, but it definitely changed shape from industrial muscle to financial and tech-heavy power. Fast forward to today, and the pattern is still there, just more extreme. The US continues running large current account deficits, even when numbers temporarily narrow in certain quarters. It's like a long-running habit that never really got corrected, just managed. And underneath all of that, the liability side keeps growing heavier. Foreign ownership of US assets has expanded massively compared to what America holds abroad. That imbalance is the quiet pressure point nobody sees on the surface when they talk about strong economy. Now here's the key twist that messes with people's expectations, because normally rising debt like this would weaken a currency fast. But the dollar still holds most of the global reserve share, which means the world keeps playing along. So America stays powerful, but also increasingly dependent on everyone else's trust. On top of that, Long-term fiscal projections show debt and deficits climbing further in the coming years. That doesn't automatically mean collapse, but it does shrink the room for policy mistakes. In simple terms, the margin for error is getting thinner while the system gets more complex. So when people ask where did US power go, the answer isn't a dramatic fall or a rival takeover. It's more like a slow trade-off where dominance stayed intact, but flexibility quietly eroded over time. And that's the real tension sitting at the heart of the modern global economy. This is where the whole safe asset thing becomes a big deal. Global investors, central banks and institutions needed something liquid, stable, and trusted when chaos hit their own economies. And for decades, US Treasury markets became that default parking spot for global cash. So even when America was importing more than it exported, the money didn't just disappear into a black hole. It came back in through capital inflows, buying US debt and funding the same deficits people worry about. That's why the system looks like a loop instead of a straight decline. At the same time, globalization kicked into high gear and basically rewired production across the planet. Manufacturing shifted to cheaper labor regions, especially across Asia, while the US moved deeper into services, tech, and finance. This wasn't a sudden collapse, it was more like a slow relocation of the physical economy. China's rise fits right into that shift, but not in the simple replacement way people talk about online. China became the factory floor of the world, while still plugging into a dollar-based trade and financial system. So even the biggest challenger was still operating inside the US-led framework. That's why the idea of a single new global currency never really took off. The euro came close in theory, but it never fully replaced the dollar in global reserves or trade settlement, and the renminbi, despite growth, still sits way lower in global trust and liquidity. Instead of one winner, what actually formed was a layered system of dependence. Countries might trade locally, but when it comes to savings, crisis protection, and global pricing, they still fall back on the dollar. It's like everyone left the house, but still keeps the same emergency key. Then the 2008 financial crisis hit, and people expected that moment to break US financial dominance. American banks were at the center of the storm, and global confidence looked like it should collapse. But what happened instead was the opposite in the long run. After the crisis, investors didn't run away from the dollar, they ran toward it. US treasuries became even more attractive because they were still seen as the safest place in a burning global economy. So crisis didn't replace the system, it reinforced it. To stabilize everything, the Federal Reserve expanded its balance sheet massively through quantitative easing. Money supply increased, interest rates dropped, and liquidity flooded global markets. But instead of killing confidence, it actually kept the system from breaking apart. That's when a strange pattern started showing up in full force. America could print more liquidity at home, and the world would still treat its assets as the safest storage of value. It looked less like control and more like dependency wrapped in trust. Meanwhile, emerging economies kept growing faster, but their currencies didn't gain the same global role. Growth in GDP didn't automatically translate into financial dominance, because in global finance, trust, liquidity, and history matter just as much as raw output. So the system became kind of uneven, almost like two worlds running at the same time. One world produces goods, builds factories, and expands population-driven growth. The other world issues the money everything else relies on to settle trade and store wealth. And inside that structure, the US kept absorbing global savings whether it wanted to or not. Foreign surpluses had to go somewhere, and the deepest, most liquid markets were still American. So capital kept flowing back into the same center, even as production spread outward. That's the core contradiction building under everything, because power isn't just about making things anymore. It's about who gets to issue the liabilities everyone else is comfortable holding. And in that game, the US still sits at the top, but with heavier and heavier responsibility attached. By the time we reach the present, the system doesn't look like a rise or fall story anymore. It looks more like a long tension that never really resolves. The US is still at the center of global finance, but the center itself is carrying more weight than it ever did before. So power is still there, but it feels more like management of pressure than clean dominance. One of the biggest signals of that pressure is the size of America's external position. The country owes far more to the rest of the world than it owns abroad, while still issuing the main asset everyone wants to hold. That combination sounds stable on paper, but in reality it only works as long as trust stays locked in. And trust is the real currency underneath everything now, not just dollars or bonds. Because global investors don't just ask, what is this worth? They ask, will this still be safe during chaos? That question is what keeps US assets glued to the top of the system, even when debt numbers look uncomfortable. At the same time, the global reserve system is slowly getting more scattered. The dollar is still dominant, but its share has been drifting down over time while smaller currencies pick up minor roles. So instead of a straight replacement, you get a slow dilution of concentration. This is where the story gets misunderstood a lot, because people expect collapse or replacement, but what actually shows up in the data is gradual diversification, not a new king of money. That means influence spreads out instead of flipping from one center to another. Inside the US itself, fiscal trends add another layer of complexity. Government deficits keep running large, and debt is projected to keep climbing in the coming years. That doesn't instantly break a system, but it does tighten the space for future decisions. The tricky part is that the same system that creates these pressures also delays the consequences, because global demand for US debt keeps financing those deficits, which pushes adjustment further into the future. So the problem doesn't explode, it accumulates quietly. And that's why the phrase "lost power without a competitor" actually makes sense in a strange way. There was no single rival that replaced America, because the system never produced one. Instead, the structure itself evolved into something more distributed and less centered. America still has major advantages that no other country fully matches. Deep capital markets, military reach, innovation hubs, and the ability to issue the world's main reserve asset all still sit in its hands. But those advantages now come with heavier obligations attached than in earlier decades. In the long run, that creates a different kind of leadership problem. It's not about being overtaken, it's about being continuously relied on while also being gradually stretched. The more central you are, the more everything else depends on your stability. So the real shift isn't visible in a dramatic full moment. It's visible in slower changes like rising debt, shifting trade patterns, and diversified reserves. Each one alone doesn't look like a crisis, but together they change the shape of influence over time. That's how systems evolve without breaking. If there's a final takeaway, it's that power today isn't a fixed position, it's a balance between trust and obligation. The United States still sits at the center of that balance, but the center now carries more weight from the rest of the world than ever before. And that is what makes the story less about replacement and more about gradual internal pressure inside a system it originally built.